Hello guys, my name is Mubashir Ansari and today we are going to analyze MRPL stock. Before we start with that stock, I was thinking to start with the index analysis. So let's check the closing price of the indexes. Today is Saturday and the market is closed today. Let's see what happened on the Friday. Okay, let's start with the Nifty 50. Okay, as we can observe that the market has broken its previous support here, which where market has been taken two times support, because of which it is become weak. We can say that, and by making here order block, market has dropped towards the level of around 24,931, and now it is been trading 24,965. And it is being in a consolidated mode, and the next support is around 24,850. Okay, let's see the bank nifty. Bank nifty is also sitting on a support of 56300, and the next support will be around here 56180. We can say that the round off of 560 56,000 around. Okay, and the drop was around looks like it is a big drop for the company. The Nifty 50. Let's go with the Sensex. Okay, the Sensex also on a support of around 81,500, currently trading 81,740. It also dropped here from the. Okay, let's go with the MRPL. Let's check the technicals of the MRPL. So let's go with the 1 year chart. Okay, so we just want overall what's going on in MRPL. Okay, let's go with the overall. Okay, looks like the stock is being stagnant for the was the stock okay, so it was listed in 1994. Okay, from there it has been given was been, we can say that it was been in stagnant mode, like it was got skyrocket after in 23 in the bull run of the 23. Okay, that or after that it was also crashed from here. Okay, now if you in short, if you have buy that stock in 1994, and after 30 years, you will be having around 3x of whatever the money you hold. Means it will be not even covering your inflation. It was a failure, we can say failure. Okay, let's go with the stock, what company does and all. MRPL is a full form of the Mangalore Refinery and Petrochemicals Ltd. Okay, what is the solid petrochemicals? Means the oil and natural gases. It is a subsidiary of ONGC. Okay, the company is mainly engaged in the business of refinery, crude oil and petrochemical business, trading of aviation fuels and distribution petroleum products. Okay, first of all, it is a joint venture done by the AV Birla Group and Hindustan HPCL. Okay, Hindustan Petroleum Corporation Limited. Okay, it is a joint venture made by the AV Birla Group and the HPCL. Let's go with the market cap. First, market cap of this company 26,000 crores, means it is a mid stock. Okay, The stock is not giving their lessee. What's the reason? What's the reason of not? There is no P. Okay. See. Okay, it has a negative EPS earning per share, because of which the P becomes negative, means irrelevant. Company is not making any profit for now. That's why their stock P not giving there. For return on capital employed and return on equity is quite too much low. That's not a good sign. And return on capital employed is greater than return on equity. That shows that the company is using too much borrowing in order to make profits. That's also not a good sign, which leads to the higher interest coverage. Oh, look at that. They have a company is not even able to capitalize its interest obligation. It has a debt to equity ratio of 1, which is up the boundary, which is not a good sign. And company is having a 88.6% promoter holding, which is more than threshold of the SEBI guidelines. Means SEBI has mandated that the promoters cannot hold more than 75% of the shares, and otherwise they have to dilute. Means in a short duration they are going to dilute the remaining 30%, 13.6% of the shares. I think which leads to the more drop in the price, and it will become like 50 or 60. Means it is a issue price. It is a issue price. I think that. Anyways, EPS growth of the 5 years is 50.1%. That's good. I mean, for the capital intensive industry like petroleum, oil, and natural gases, this type of EPS is quite good. As because of they have to incur huge expenses for the capex, machinery, plant, and all, and they have to face the problems because of the government policies, price changes, price fluctuations, and all. They have not pledged any share. That's good. And current market price and book value look like they are price to book value ratio is 2. Okay, it is quite good, as Indian companies have that, more than that even. Sales growth of the 5 years quite acceptable, good, and for this 10 years not acceptable. Average dividend payout is too low. I mean, this kind of companies must pay high dividend. I think because as we already observed that this company is not making profit at all. That's why they are not able to pay dividend payout dividends. Okay, EBITDA is too much high, because this kind of country, sorry, I mean this kind of companies is not should have that much of enterprise value, total value, as compared to its book value. I mean it is profit. Current ratio is around 1, and quick ratio is 0.35. Means company is not liquid at all, and most of the its products, or we can say stocks, are being in inventory. That's not good. That's not good sign. Let's compare it. Let's see it is peers. Okay, peer comparison. The companies by market cap, we can say that it comes at the fifth position. And let's start with the quarterly sales variance. Looks like company is not going backward. PAG ratio is not there, as the company was having a negative EPS. EPS of 12. Okay, it is not good. Sales variance for the 5 years, it is quite acceptable as compared to others. Profit variance for the 5 years, it is also good. Interest coverage is bad, and current market price to book value is acceptable. EBITDA is too much high. Current market price to the sales is 0.29. Means for each rupee of sales done by the company, investors are willing to pay 0.3%. That's not good. Return on equity and return on capital employed is quite not acceptable as compared to its peers. Let's analyze the quarterly results. Okay, we can see that within the span of 3 years, companies become sales become around half. We can say it still become half from June 2022 to towards the June 25. That's bad sign, too much bad. Material cost has been too much. Look at that. Material is cost is too much, which leads to the lower operating profit. Look at it, 1%. This look like companies paying. Companies not earning from the customer. Customers are earning from the company. Anyways, interest obligation has been stagnant, quite low, not that much we can say stagnant. Depreciation is being also stagnant, even increased little bit, which is not good because company is not earning at all. Now let's move towards the profit and loss on P&L account or income statement. Sales growth from the for the from 24 towards the 25. Within 10 years, the company is not even able to double its sales. It is we can say the 1.7x of the from the 2014. Sales growth is quite from 2021. Company was having low sales. We can say it was going backward. But after 2022, companies look like recovering from that, which is a good. And material cost, oh look at that, 101%. Looks like company literally paying customer. And it is material cost is quite too much high. Company needs to increase its efficiency. I think it is not because of the efficiency of the company. It is because of the policies of the government and the fluctuation the prices of the fuel and gases and all. Operating profit margin is too much low. It is fluctuating too much. We can see that 1 minus 4 4 11, even 9 4 16. It is quite too much fluctuation in the operating profit margin. The interest obligation has been tripled and depreciation obligation has been also doubled, which is a bad sign as the company is not earning at all. Balance sheet. Let's see balance sheet was going company financial position, equity capital, company is not raising anything here. Results. Looks like company at least reserves. Looks like company at least increasing this reserve for the future purpose, or we can say for the capex, in order to the capex. Long-term borrowings. Company has reduced its long-term borrowings for the past 5 years. We can say that. And short-term borrowing has also been reduced. And lease liability is not a big concern. Trade paper also been reduced, which is a good sign. Fixed assets. Looks like company is investing heavily on fixed assets like land, building, and plant and machinery too. Okay. Capital work in progress. Looks like company is investing have some capital which is being under construction. Okay. Other assets inventories is being reduced to goods and trade receivables. Trade receivables increasing, which is not that much good. Okay, cash and cash equivalent is become like nearly zero. We can say that. I mean, if you compare from 10,000 and 31, it is like there is nothing left. Cash now cash flow shows the actual picture of the all the sales given, their sales profit and many things, investment and all. Cash flow from operating activity, as we can observe that in order to analyze that, let's calculate the total of the 3 years. Okay, let's say it is 2007, 9 and 6, around 15,000. Okay, means company has earned 15,000 crores in cash. And what profit and loss account shows, company has earned around 10,000. Looks like company has received money from its workers. Okay, receivables have been you can say that it is quite too much fluctuation there in receivables. look like here company received look, but overall company's receivable has been increasing. Inventory also increasing over the years, and here was a big drop, and here was the big drop, and here was the big drop. Looks like it was balanced overall. Tables have been increasing too. No, it was balance. Look like balance. If you look the biggest amount, company is one doing one time payment. Looks like okay. Cash from investing activity. Cash from investing activity shows that from where company invest and dividend received, land and machinery purchase and all. Okay, fixed assets. We can see that company is utilizing this profit for the purchase of the fixed assets and all. Interest received and dividend received. Okay. Cash from the financing activities from where company get the money, borrows the money. We can say that borrowing from proceed from borrowing, companies reduce its borrowing. Okay, that's it. Repayment of the borrowing is quite good. You can see that the companies continuously repaying this borrowing, and interest in financial. Okay, dividend paid. Okay. Let's see overall the ratios of the debtor days. Looks like companies reduces its debtor days and inventory days too. And days payable. Days payable reduces it is a bad sign, as if days payable is higher, then company can use it is creditors money to keep rolling it is money without their own money stuff in the process. Initially, they were having a negative cash conversion cycle, showing that they were using the creditors' money for the business. Now they have started using their own money. Okay, that's not good. Let's see the confidence of financial institutional investor FIIs. Okay, looks like over the 5 years, FIIs interest has been reduced, and domestic institutional investors interest has been reduced too, and public interest has been increasing over the years. That's good. I mean, the company is not doing good at all. As how public is still want to purchase these shares. Anyways, everyone has their own mindset to decide to whether to purchase or not. Let's see if there are any important announcement like resign. So CFO has been resigned in 2024 July. Okay, and if there is it is a big red flag if we see continuously key person resigning from the company. That's why we analyze this too. Okay, there is no another important news here. Okay, let's see. Okay, there is no information about content. Okay, learn that here. Okay, so they have appointed CFO. We already analyzed that, saw that CFO was resigned. Anyway, let's see their credit rating. Okay, looks like they are having a AAA credit rating. That's good for the business. Okay. So overall, if you ask me if these stocks are to be bought or sold, or we can say hold, I can say that don't buy this stock, as we can see that this company is struggling to exist. I mean, they are not making any profit. They have interest obligation, they have depreciation obligation, they are continuously buying their debtors. This has been increased. Their payable days has been reduced, and companies facing too much problems for over the years. I think after 1 or 2 years we can return analyze this company. If the company become profitable, then only we can decide. And company is not even able to manage its operating profit margin, having only 1% operating profit margin. That's a very bad sign for the company. So thank you for watching. Have a nice day.